Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Null. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Now, regular listeners know that I promised that Michelle Lee Melton would be back this week, and I fibbed. She ended up, we record our show before the weekend, just full disclosure. Michelle has a real job outside of the millions that she makes from this radio show. She has a real job, city planner for the city of Fairhope. And she got stuck in a meeting. So I am very excited to announce that I had an emergency sub. It is John Luke Tyner of Aptus Capital Advisors. John Luke, how you doing, man?
I'm good, Josh. Thanks for having me, and this is fun.
This is going to be great. So he joined us. We're here in Coastal College's recording studio, beautiful downtown Fairhope, ready to put together a great show for you all tuning in today. Listeners, John Luke and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store for you. First segment, deep dive on the topic of the day, and I'm going to give you a heads up. It is going to be a super, super relevant and super recent topic, right up John Luke's alley here. Second segment, about 25 minutes past the hour, we will have the news headlines of the week. And then roughly 45 minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And we got some predictions to both look at and maybe possibly make. Quick background on those of you new to the show. Again, my name is Josh Null. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, do not worry. Grab a pen and pad. We will repeat it several times throughout the show. One more thing, John Luke, before we get to our main topic, I want to do a quick disclaimer for the compliance, and also help our listeners understand the role that Aptus has with Gulf Coast Financial Advisors. As I mentioned in the open, you're with Aptus Capital Advisors, but one thing I didn't mention is your title, Head of Fixed Income and Portfolio Manager. I'm going to circle back to that after this disclosure. I want you to explain that a little bit more, okay? But first, the disclosure, get back to it here. So Aptus Capital Advisors technically serves as a sub-advisor to my firm, Gulf Coast Financial Advisors. What that means in plain English is that Aptus helps our team with our clients' investment accounts, including portfolio construction and trading. And that's just among the many, many services they provide to me and my clients. They do a great job. What it does not mean is that John Luke or Aptus is employed directly by or for Gulf Coast Financial Advisors. John Luke's advisory services are offered through Aptus Capital Advisors. That is a registered investment advisor registered with the Securities and Exchange Commission and based in Fairhope, Alabama. Lastly, Aptus Capital Advisors and Gulf Coast Financial Advisors are not affiliated. All right, let's get on with the show here. So I mentioned on your title, John Luke, before we dive into our topic, what does Head of Fixed Income mean, Portfolio Manager? Tell us about that.
Yeah, thanks, Josh. And again, excited to be here. What a cool recording studio. This is neat. But yeah, within Aptus, we're really focused on helping advisors in the space manage portfolios, and it's a unique outlook that we have, or a unique investing environment that we think really requires some out-of-the-box or innovative thinking when it comes to constructing portfolios. And, typically investors have looked at stocks as their growth engine and bonds as the interest income, or getting paid some income off of the portfolio, but also a defensive area for portfolios. And that really hasn't worked the last couple of years. So my job started really trading bonds, muni bonds, corporate bonds, treasury bonds, out of college. And so I got a really nice backdrop of how to use bonds and how to trade them, and risk management being forefront of the mix. But when it comes to fixed income, many retirees need bonds, or they need the income on their portfolios to live their lives. Like you said, live their best life down here on the coast. And so what I focus on is helping generate income off of fixed income assets, but doing it in a really risk-managed type of way. And one of the big things when it comes to being a fixed income investor is, where the return comes from. There's no growth in bonds. Uncle Sam doesn't call you back and tell you, hey, inflation was X or Y.
Right.
We're going to write you a check for the difference. You're stuck with what you get. And so we really at Aptus try to be innovative within the fixed income space to create products that give fixed income like return profile or fixed income like risk profiles, but add the benefit or the ability to add additional return to the mix. And so that's a big piece of what I do at Aptus, as well as managing several of our asset allocation portfolios and many of the options-based strategies that we implement for advisors.
Very good. Okay, and we're going to circle back to a little bit of that more before we close the show. But for today, what I wanted to get into, this, I don't want to call this an emergency radio show, but
the market was down almost 5% today, so
yeah, maybe
that's right.
All right, so we're recording this. Full disclosure here, listeners, we're recording this on Thursday, April 3rd. As John Luke just alluded to, all the major indexes were down across the board pretty significantly. So first, John Luke, let's talk about what happened, what triggered this, and let's get your thoughts on it. I know I've got a couple of things to add into the mix. And then after a little bit of discussion there, let's transition to what should investors do, what can they do, those type of things. So first, market, broad sell-off, Dow down over 1,600 points, NASDAQ down over 1,000 points. That's, whew. S&P down over 206. So all these were down 4 to 6% across the board. Why? What happened?
Yeah, so yesterday after the market closed, Trump came out with his Liberation Day announcement, which was really outlaying his plan for tariffs on the economy, or on our trading partners, essentially. And he announced a baseline 10% tariff on all goods imported. Which was lower than what people expected. And if you were watching closely yesterday, the market rallied quickly
yes, it did.
On that
in the
news.
Afternoon. Right.
But then he came out with his what I called chalkboard. It was kind of a poster, which was a little bit comical. But it went through the reciprocal tariffs that were based on our trade deficits with our trading partners and a very varying amount of tariffs that were reciprocal based on that. And that was much more aggressive than what the market expected. And I think that was really the bulk of why the market traded off so hard today.
Well, so let's talk about your opinion on, here's the thing, John Luke, I think that, I'm going to set the table a little bit. I think that almost anybody would agree that we want to try to figure out how to get high value, high quality manufacturing back in the United States. I don't think anybody disagrees with that. As I would say, a classically trained economics major, I always joke, I got my economics degree from the Harvard of the Midwest, Missouri State University. But as a classically trained, quote unquote, economist, if you will, I was always taught tariffs are bad. Or at the very least, if you're looking at a supply and demand chart, when you add tariffs into the mix, you automatically increase the cost, right? But you had an interesting point before we started recording. What's your takeaway from you outlined why the market went down, but talk about what you think the reasoning. Is it reasonable what they're trying to do? Does it make sense? What's your thoughts on the whole tariff exercise?
Yeah, so I think you have to take a step back and look at what's the point of tariffs. I would agree from a high level that you would much rather have free trade than tariffs, because it is a regressive tax on most people or most consumers. I think when you look at the point of what Trump and his administration is aiming for, is they're really trying to do 4 or 5 things: address unfair trade practices that we've unfortunately been kind of the ill will of, and it's come with a lot of the manufacturing jobs leaving the U.S. and those good blue collar middle class jobs being sent to other countries. Was
Ross Perot, has he been justified all these years later?
I think so.
I think so.
Yeah.
For listeners who don't remember that, back in 1991, 92, he said that giant sucking sound you'll hear is all the jobs being lost to NAFTA.
Yeah.
And he got made fun of so much. And
Yeah.
is he even still alive? I don't know. I don't think, rest in peace if he's not. But not to interrupt you, but he's almost been justified.
Yeah.
Right?
Yeah.
Okay.
Well, and he got the highest amount of independent votes ever, I think, right?
He might be the last one we have in our lifetime that actually made a dent.
Had a chance.
Right.
Address unfair trade practices to correct some of the trade imbalances. We obviously import in a lot more than we export out, so we have a trade imbalance, a trade deficit. There's what Trump would claim unfair treatment by other countries with their trade policy relative to our treatment. But I think that the other big points are more on rebuilding that manufacturing sector and growing those higher paying jobs. But then also what we experienced during COVID, where supply chains got so upside down, where we couldn't get critical resources, pharmaceuticals, other components like that, semiconductors, PP&E that was needed, and it really just put a glaring hole in parts of our economy where we're so reliant on trade from other partners that whether it's something crazy like COVID or whether it was something a little bit more malfeasant where maybe our enemies that we were relying on are providing things, it's probably not a good idea to really put that weight on them. And so I think that's really the goal of what he's shooting for. And I think to kind of go back to that manufacturing piece, we've certainly taken a higher emphasis on shareholder profits because you can get much cheaper labor in China and India and Mexico than you can in the U.S. And so the big point is we took a maybe shorter term mindset of more profits for shareholders in the short run, sending those jobs away because it would have cost much more to make them and make products to have the labor in the U.S. And I'll get back to kind of a point on that. So I think if you can try to bring back, the U.S. is the center of innovation and IP when it comes to the ideas behind things, the technology, all of those pieces. Those come from the U.S. and then it's sent over to other places to make them, right? And so if we can get to maybe not being making toasters in Toledo is kind of a funny little I saw a meme or something about that's probably not going to happen.
Well, or even, again, not to interrupt you, but Westinghouse used to be a valid manufacturer of flat screens.
Yep.
Right? And I think they're long gone. Sorry, keep going.
Yep. And so it's not maybe focused on making T-shirts and sneakers and some of the low quality stuff, but it's more of the higher quality manufacturing, the semiconductors. You've seen a number of companies make what they say are going to be large investments into the U.S. economy kind of in reaction to Trump. And, we'll see if those play out. But it maybe is moving in the right direction. I guess the last point on it is what you've seen since really China entered into the World Trade Agreement, where they were benefiting from a lot of maybe what Trump would consider unfair trade practices.
Well, they were given certain breaks because they came in as the assumption that they needed help to get to the certain prosperity level as the rest of the Western world, and in doing so, they not only jumped to that point, but they kind of blew through it. Yet they're still operating under the same rules. Is that a good way to describe it?
Yeah, I think so. But the real impact to the U.S. was, we used to make all of these cars and flat screens and other, semi-advanced technology and vehicles and things like that in the U.S. And that was great jobs for a lot of blue-collar, middle-class folks. And what you've seen is many of those have been shipped out. But the after effect is when you look at the effect on the population that was impacted by those decisions, what it's led to is like one of the highest levels of opioid deaths because there's just a disenfranchised middle class now. And I think, ultimately that's why Trump got reelected.
I could not agree more. Now, so on the tariffs part, let's talk about, because you talked about high quality manufacturing. I have a certain, what I would say a little bit contrarian viewpoint around energy and cars. So first, let's talk about cars, because cars are kind of easy. Do you think that through some of the EV word is kind of a dirty word on the far right side? Fair?
Yeah.
Right. Because they feel like it was forced down their throats. There was unfair tax subsidies to promote this technology. And, if it had been flipped, I think it would have been the same reaction, because people just don't want to be told what to do, right? They want to have free choice. That said, what we've seen on the EV manufacturing, the hybrid manufacturing, is our part of the country benefits a lot from that investment, right? Yep. So do you think there's going to be, with some of these tariffs, do you think they're still going to be able to continue Georgia, Alabama, just all along the Southeast. I don't know if regular listeners know this, but there are billions of dollars being invested around and have been around electric vehicles and the power supplies to this. Yep. What do you say with that, with all the tariff work?
Well,
that's a tough one.
I think it's going to be segmented of how it affects the U.S., right? We're so big, the sectors of the U.S. and the different parts and geographies and the talent pools, I think, are a big piece, right? You have to actually have people that are willing and able to do these jobs is a big part of it.
And we tend to be non-union down here.
Right.
Yeah, I hold that. I mean, I grew up running heavy equipment with my dad and worked construction, and I'm sure I begrudged it at the time. But looking back, some of the most joyful time periods I had, and also some of I had an opportunity to actually make something, right?
Yeah.
And I look at even my boys, which I feel like I do a good job of raising them, but the way that I grew up, I felt was lost forever. So maybe one positive outcome of this is maybe we might start seeing the multi-generational blue and gray collar workers go again, where you can actually make a living and support a family on that. That's kind of one of the goals here, right?
Yeah, so I think a relocation of talent, but also it's going to be there's going to be a big need for whether it's the government or other assistance to train people, to give them the skill set, to have the schooling and the knowledge available to execute on these jobs.
Well, and I got one final thing to say before we pivot to how investors should be handling this news. For those of you all listening, I want you to keep an open mind when it comes to energy and let's not even just say EV cars or even hybrid cars. I want to be careful here and not make this a political show. Why in the world energy and cars are political, I don't know, but they are, right? But I want people to have an open mind about that because it's a fact. If you view China as an economic threat, they are wiping the slate with us when it comes to energy production and electronic vehicles. There's a company called BYD that is swamping Tesla.
Yeah.
So I would encourage people to maybe have a little bit more open mind. And when the question is, should we produce more energy of all kinds? I think the answer is yes. And should we produce more cars of more different kinds? I think the answer should be yes.
Yes.
It doesn't have to be black or white. Yep. All right, so now let's pivot to what investors should do with all this news. Because, I mean, classically, John Luke, so there's people listening to this right now, and they have been, I hate to use the word patted on the head by their broker or their advisor, but they've just been told, hey, just hang tight.
Yeah.
Just hang tight. Don't worry about it. Just hang on. You all, I know this from history, and I definitely with my practice, these are the time periods where I end up picking up a lot of business because we don't hide under our desk and because we actually have, thanks to you all and the philosophy that Aptus brings to the table, coupled with my own investment philosophy and experience, we actually have a plan when things go bad, right? So what are some of the things that, let's talk about what your day looked like at Aptus today with this market going crazy. You kind of knew things were coming. I know what you said, that the market was expecting a certain level of tariffs, but I know you well enough to know you were on your toes in case he just decided to go full gravy with it, right? Which he did. So what was your day like, and how does that impact investors, some of the work that you all did today?
Yeah. Well, and I think, you take a step back and Trump's taking some shock therapy versus maybe a gradual rebalancing, and that's probably because of some of the nature of our election cycles, right? He basically has 2 years to do things.
I would argue he's got a year and a half.
It better be quick,
right?
Because if he causes too much turmoil, the midterms will be
elections tend to be pendulum. I know, it always feels like, I mean, honestly, you're old enough, but there was a time period after Obama's first election where everybody thought, well, there's no way. When are we ever going to see a Republican president again? Right? There tends to be a pendulum, and I know it's hard to see that with the somewhat overwhelming victory that Trump and MAGA had. That said, it would probably not surprise a lot of political pundits if the House went back to Democratic on the next midterm elections. So I do think he's on a ticking time frame.
Yeah.
So shock therapy, like you said,
And that puts him in a go-get-it type of stance. There's this administration is different from his first go-round because the first go-round he led with tax cuts and some deregulation. So he kind of led with candy on the first go-round.
I don't think he expected to win the first time, to be honest with you.
Yeah, that's probably true.
Yeah.
And I think he even says that. But he led with candy with the tax cuts, and it really got the economy fired up. Remember, right after he won the election, the market just ripped at the end of 2016. And so the spinach of tariffs came at the latter part, and they were much softer in that go round and really targeted towards China. For better or for worse, Trump's got China in his crosshairs.
He's been consistent with it, let's be fair.
Yeah.
I mean, this is not something, if I have followed Trump for decades, it used to be Japan was more in his crosshairs back in the 80s and 90s, but once Japan kind of fell off, it's definitely, so he's been consistent.
Yeah.
No doubt.
And so this go round, he's really focused on the spinach first. And
spinach being terrible is what you're saying.
Yeah, that's
Michelle, if you're listening to this, nobody likes spinach.
Yeah, when you sat down at mom's dinner table as a kid, you had to eat the spinach before you get the dessert, right?
You're right.
Before we got the dessert first. So this time we're actually following maybe the right order, and I think that the dessert later is more tax cuts, potential deregulation, lower taxes for kind of that middle class type of space, maybe some targeted fiscal policy directed at different segments that maybe are impacted by tariffs, like agricultural has already been in the headlines of potentially getting some, quote unquote bailout packages to deal with the ill fall from tariffs. And so to get back on point, we're not panicking when you get days like today. It's really a fun day in our office when you get these types of moves. When you look at what the market did, where, like Josh said, the S&P was down a little less than 5%, but the VIX index, which is kind of the fear gauge of the market, really it was up like 30%, but it's still less than 30. That's not really when it comes to markets in turmoil or chaos. When you get these types of moves, it's typically when the VIX index, when the fear gauge for the market is much higher than these levels. So it was a little bit odd kind of having that play out. But one of the key pieces of our strategies at Aptus is we buy hedges on the market and we actively manage them, right? And so when you own a hedge, you have something that's negatively correlated to the market. It's kind of like insurance, right? But the hedges are priced on the sentiment of markets and what markets are expecting. And when you get a down 5% day, the price of that insurance goes way up. So you want to make sure that you own it before everyone's kind of screaming in the streets, and we did. So it really puts us in a good spot to manage that insurance protection against the downside. So if more, I think really the big question was today it, or is it just the start of something a little bit more ugly?
Right.
And I think that there certainly could be more to unpack, just with the amount of uncertainty and the magnitude of what Trump came out with yesterday, where we could see more behind this.
All right, so to put one last thing on the hedging, just for regular retail investors, what you're saying is there's a very small portion of the portfolios is used to buy a type of what's called a put contract, right? Yep. When the market has significant dips, and there's more math to it, I'm oversimplifying, listeners, but when the market has a certain level of dip, those are exercised to a multiple of whatever you invested in. Say if you bought a put for $10,000, you might be able to multiple it up to what, 3 to 5x of that? Is that fair?
Or more.
Depending on when you bought it.
Yeah, and depending on what the market does.
Right. And you all have been in this space for years, so it's not like a lot of people that were actually searching for hedges and they're a little bit late, or they're paying a premium on it.
Yep.
So with that, you're generating the cash. So you're taking, let's say, $10,000 on $1 million portfolio. You're generating you're paying $10,000 for this hedge. It's generating $50,000 in this example. What's that $50,000 doing?
Yeah, so that helps sort of buffer the downside of when markets are falling lower. So you want to help protect when markets are falling. That's what the insurance and that correlation benefit comes into play. But really, the other side of the coin is you want capital that you can redeploy back into the market after the turmoil has happened. And typically that's when everyone wants to get out of the market. So It gives you a great opportunity to get capital reinvested back in when most people wish that they had it. And so within our investment process, the active management of the hedges gives us two critical advantages. You can help protect on the downside. You can create capital to redeploy back into markets when they're cheaper. And then the other piece is it's a tool for within your asset allocation. So we think that stocks compound at higher rates than bonds over long term and give you the best opportunity to compound at real rates of return, real positive real rates of return. So that's after inflation. When you own a share of a company XYZ stock, what you're really buying is their future cash flows, which are hopefully growing. And so what we're trying to do is enable our investors and our advisors to own more stocks in their portfolios and have less of the handcuff of traditional fixed income. And so we help them compound at higher rates of capital or higher rates of return. But you've got these hedges in place to keep the risk in check, right? If you add more stocks, quote unquote, you add more risk. But if you do a good job with the hedging and how we deliver it, I think can really help position clients to compound their capital at rates of return that help them meet their objectives and their financial plans.
Is it fair to say that you all are hopefully buying at a long-term discount when people are fleeing for the exit door?
Yes.
Right. All right. Very good. All right. Well, great job. First segment is in the books, man. How you feeling?
Yeah, this is great.
That was fun. All right. Now, folks, for those of you all that would like to start your own conversation about your personal investing and retirement goals and dreams, we encourage you to reach out to us. You can call us at 251-327-2124, or you can find us on our website, Gulf Coast FA is in financialadvisor.com. On our site, upper right-hand corner, there's a blue button that will put a 15-minute introductory phone call on my calendar. If you want me to call you, make sure you include your phone number. Plus, for those of you all like to do business in person, like I do, you can always schedule a no-obligation, no-hassle-free meeting at any of our 3 convenient locations. That's downtown Fairhope. We're in the Portico building right by the post office. Or we have an Orange Beach office that's off Canal Road, just down the road from the wharf. Or Mobile, we're near the intersection of Dolphin Street and I-65. Any of those 3 locations, we'd love to meet you. All right, folks, coming up next, there's a lot going on in the world, particularly the world of finance, investments, and money, especially this week. Every week, we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So join us after the break to hear John, Luke, and I discuss this week's relevant headlines in our News Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Null here. So as we discussed before the break, every week we scour the internet for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now note, if you want to read our referenced articles yourself, we include the links to the articles in our show transcript, which you can find on our website, gulfcoastfa.com. Just look under the podcast tab. We put it up there after this show airs every week on 106.5 and on 92.5. Now, so without further ado, I'm going to read the headlines, John Luke, and then you're going to react. You ready for this?
All right.
Yeah, sight unseen, folks. We're going to see just how nimble he is. All right, our first article. We're going to dive into what we talked about in the first part of our show, tariffs. Fox Business has a headline that reads, "What to Know About President Trump's Liberation Day Tariffs." So what we finally know is the proposed amounts of the tariffs, and I like how in the opening you talked about his chart, which I got to hand it to Trump. Only Trump would think about, well, this stupid thing's going to blow down and look bad.
Yeah.
So I'm just going to have to hold it and wing it.
Yeah.
And he did.
Yeah.
It's
the memes on Twitter after
it's
were
so
pretty
hilarious.
funny.
Oh, I bet they were great. So what we don't know yet is the economic impact that these tariffs will have. And I would argue we don't know how these tariffs are even going to be erected and enforced, right?
Yeah.
So I'm going to put on my economist hat, my economics degree from the Harvard of the Midwest, Missouri State University. But let's talk about you. With all of this going on, what do you think? We already talked about what we thought in the beginning. By the sheer nature, tariffs tend to raise prices. However, as John Luke and I discussed, especially in John Luke's opinion, there is a method to the madness here. So I'll tee you up this way, John Luke. My dad always had a saying. Anticipation of the event is always worse than the actual event.
Yes.
So what do you think is going to be are we looking at just the end of all globalization, free trade? It's over. We're all going to go back to, living like we're the Middle Ages, or are we going to start, or is America going, what's going to happen?
Yeah.
Where are we going?
So one of the other pieces of, the point of Trump's tariffs, which was lower down the list, but was to raise revenues. He ran a lot on that as helping to push some of the tax cuts.
Offset some of the income tax.
Right?
Right.
Right. And so if you look at, and again, it's very preliminary because it depends on how the countries receive kind of the proposed tariffs that they were hit with, right? As far as, do they accept them? Do they negotiate and maybe get a better deal, or do they fight and maybe get a worse deal? Scott Bessent, who is the Treasury Secretary, focused on a couple of key things, but he was on the news right after Trump spoke yesterday. And, I don't know whether he was involved or not in the conversations, but I think a key thing that he said was, if you fight back these, you're probably going to get a better deal. If you agree to them or negotiate, there's maybe some willingness to set the stage.
Well, again, I can't crawl around Trump's head. I just have followed him for decades. And one thing I think is pretty consistent is he actually he respects you more if you fight back. Is that fair? I mean, that's what it seems like from the outside looking in.
Well, I think he wants to negotiate in, friendly-ish type of terms, but he's going to take the upper hand on at least from the start. I do think that for many of these countries where the trade piece or their exports out to the U.S. of stuff that we're buying or stuff that they're buying from us, like typically we're buying more from them than they're buying from us.
Right, because we're a consumer society.
Exactly.
Right.
And so if we through these different if we through different varieties impact what we buy from their economies or maybe shift it to somewhere else, it's really impactful to their countries. I think one of the crazy stats is if you look at tariffs or if you look at imports as a percentage of the GDP in the U.S., it's like 15%. So that means 85% is domestic, related to domestic activities. If you look at China, Europe, Southeast Asia, many of these other countries, their amount of what trade means to their economy is like 50+%.
Oh, wow. Okay.
And so I think that, what people maybe aren't expecting is there is some there is some advantages that the U.S. has that they're kind of maybe have the upper hand in some of the negotiations.
Well, let's talk about the other thing they mentioned in this article is Trump actually wants to devalue the dollar.
Yes.
Which to a regular listener right now that doesn't pay attention to stuff like we do sounds scary, right? What do you mean my dollar is going to be worthless? Walk through how when the U.S. dollar is devalued, how is that beneficial to us, particularly as consumers and or investors?
Right. Yeah. So from an export perspective of stuff we make in the U.S. that we want to sell to other countries, well, if our dollar is weaker and their dollar is stronger, whatever their currency might be, that gives them more purchasing power to buy our stuff. It makes our stuff more competitive on sort of the global circuit. And so the goal of a weaker dollar is to make our exports more competitive so more people buy stuff from the U.S., which would kind of circle back to the goal of, well, we got to make more stuff in the U.S. for people to buy.
Well, and plus, too, Trump makes the thing that other countries will manipulate their currency so that it's weaker compared to the dollar.
Which gives them that advantage.
Which gives them the advantage
inverse of what I just said. Yeah.
Very good. All right, next up, we've got an article from Yahoo Finance. It's a recently titled article from, it's called Barry Ritholtz Explains How Not to Make Stupid Mistakes. Now, you recognize the name Ritholtz Wealth Management, correct?
Yep.
Yeah, and that's Josh Brown, the reformed broker, right? So I'm actually fans. Now, you're more knee-deep into the everyday investing, so they probably come off at times maybe a little cartoonish for you.
Yeah,
is that fair?
A little.
A little? But I do think that of the really successful ones, successful companies that actually feel like they're at least telling people the straight skinny, or at least how they believe it, I feel like they're one of the better examples. Is that fair?
You can't knock their communication. They're everywhere.
This is true. I wish I could figure out how to do like they do.
Yeah.
Well, so Barry Ritholtz, he's one of the founders. Again, Josh Brown. Josh Brown came to fame with a blog called The Reformed Broker, right? He has a new book called How Not to Invest. So one of the things, as a high volume reader of this stuff, an overly curious person, Again, I feel like I try to get. I have read so much garbage in our industry. I don't know if you get as irritated as I do as some of the stuff that's put out there.
Yeah.
You ever sit there at night and you see a commercial, and the commercial says one thing, but because we're in the business, we know what it's actually saying.
Yeah.
And it drives you nuts.
And how much money that those types of publications have cost your average investor that, isn't in the weeds, but they're following it day to day and making investment decisions with their life savings based on some crap some guy said on, Yahoo.
Right. And I hold a particular, if as you become now a regular listener to the show, so just like Josh Brown is the reformed broker, I would be the reformed insurance guy.
Yep.
Right. So I came up on the insurance side. And I was always skeptical, so I'm proud of that. I never drank the Kool-Aid fully. But part of the thing that really we try to educate people on is you got to be really careful about the annuity shops.
Yep.
And for whatever reason, they tend to be a little stronger down here in the South. I don't know why that is. But just like you were saying, I'll have people come in with a story or an explanation on typically it's a fixed index annuity, and the story that they are given and what is actually reality are not the same.
Yeah.
And I don't know if I know you don't deal necessarily with the retail facing, that's my job, and you all help me, but what are some things that you see out there that along the lines of putting out good information, like you said, these guys are everywhere. Is there anything particular you see that, especially now with all this turmoil, that investors should pay attention to and maybe know what is actually going on?
Yeah, and I'll try to think about it from a retail side. I'm more on the institutional side, and the news sources that I view are a little bit different from Fox Business or CNBC or some blogs. But the key thing that we saw at the start of the year is from an asset class perspective. You have U.S. stocks, you have international stocks, you have emerging, and then many subsets, small caps, etc. What you've seen the last maybe 15 years is U.S. domestic large cap stocks, specifically growth-oriented stocks like the Magnificent Seven, have outperformed pretty much everything by a lot.
They have carried the load of the total gain.
And so what you saw at the beginning of the year and maybe the end of last year, really aggressive, was why do we own any international stocks in our portfolio? They've sucked. Let's own more of this. And, the timing of that couldn't have been better, where international stocks for the year are positive. And
you mean worse, Trump made international stocks great again?
Right.
Is that a fair statement?
Well, so far.
So far.
We'll see. From a valuation perspective, they were very much more inexpensive than the growth stocks were. There's a lot more that goes into that mix. But if you would have listened to someone on, XYZ TV or blog, and you would have rotated into growth,
right,
you would be feeling it this year.
That's right. Yeah, you got to be so careful because you got to remember the majority of them are on there to sell either a product or service or to sell advertising.
Their newsletters.
Yes, absolutely. Now, I do think there's one thing that I think Ritz-Holt says that you totally agree with, and that is, and I know because I know JD does, that's the power of compounding when it comes to the stock market. So he always asks people, if you put $1,000 into the stock market at normal market returns, what would it be worth a century later? And he says most people guess somewhere around $1 million or $2 million. He tells them, tell me if you agree with this, but I haven't checked the math. It's somewhere in the neighborhood of $30 million a century later. Does that sound about right? With all compounding?
Yeah.
It's a huge number,
I've
whatever
looked
it
at
is.
some numbers of like if you bought in, 1920s and held to today, and it's an insane number.
Gosh, come on, Grandpa. I wish he'd done that.
Yeah, I know. What were they thinking?
He did buy land in Wapapello. They compounded it a little. So Wapello, Missouri. All right. So
and I think the other piece too is on like CDs or treasuries.
Yeah,
where,
let's talk about that.
I can get you a 5% yield.
Right.
And what people fail to think about is, all right, 5% sounds great until inflation is 3 or 4%, and that eats at your return. And then you're paying taxes on that 5%, which interest expense is taxed typically at your highest bracket, like ordinary income. And so just say, for simple example, if you're at 5%, you're going to pay 40% of that to Uncle Sam. You're left with about 3. If inflation, which has averaged about 3% the last 75 years, well, you're left with 3, inflation's 3, your real return is 0. And I think many people have gotten comfortable with being safe because they can get that 5% without thinking about the long-term repercussions of your after-tax, after-inflation returns.
Your real return.
You're getting debased by the second, with the value of the dollar. And you've seen that happen year after year after year, and it probably will continue.
Well, and I don't want to get as overly simplified as a buy the dip person, but what's your thoughts around the fact that there is so much monetary supply right now when you see such a broad sell-off? And one would argue, the stock market can act like a 13-year-old boy in any particular trading day. Is that fair?
Oh, yeah.
Yeah, you deal with it all day long. So you have this incredibly emotional sell-off, yet as opposed to even say back in 2008 or definitely back in earlier in the past century, there's so much monetary supply. How does that play into our potential of a rebound or potential of what investors we might see, especially on the institutional level, happen over the next handful of days or next handful of weeks?
Yeah, I mean, I think people are certainly going to be incentivized to buy the dip, especially folks that maybe sat in cash over the last couple of years and missed out on, what the markets gave us. A lot of the backdrop the last couple of years was really relying on very expansive fiscal policy. So that was many of the programs that came after COVID, the CHIPS Act, the new Green Deal or whatever, that came and just pumped tons of money into the economy. And many stocks, which are sort of a measure of liquidity, were there to soak that up. So I think that you're still a long way from working a lot of those excesses off. It's just the many of the policies that are being in place are kind of tightening the belt on that backdrop.
All right. So last article of the day. So would you say in general, all investing involves risk, right, John Luke?
Yes.
But in general, at Aptus, you all are going to be investing in things that most regular retail investors could look at their statement and like, oh, okay, I get that. Yeah, I recognize that company. I recognize the point of that fund. You're not going out there and we don't have like some crazy meme coin stuff going on inside Aptus investment portfolio, right?
No.
Okay. So that said, about terrible advice, I think that we are ripe right now for a lot of terrible financial advice coming on because anytime there's volatility, there's people that want to prey on people's fear selling. I mean, I don't know if you agree with it or not, but JD does fear sell in our industry? Unfortunately, it does.
Yes.
So you see it with preppers, you see it with convert your entire portfolio to gold, you see it with crypto, you see it with all these things, right? And one of my personal experience is with a book that a lot of people recognize called Rich Dad, Poor Dad by Robert Kiyosaki. I think that's how you say his name. And I cannot tell you how damaging this stupid book was to my real estate career because the problem was he was right back then. I mean, I could get into these deals with minimal cash down, leverage to the hilt, cash flow at one to the other, you're just constantly spinning plates, and it all works until the music stops.
Yep.
And when the music stops, then everybody wants their money back. Like a buddy of mine told me multiple times, these bankers, not your friends, Josh. Remember that. So I feel like right now, especially with social media giving people an advanced megaphone, that everybody needs to be very careful, especially for some of you all that have significant losses in your portfolio. If you lose, not that maybe you have or haven't, but if you lose 50%, mathematically you got to make 100% to get it back to the same point, right?
That's the volatility tax.
And a lot of times when you are trying to get that significant back, you turn to gambling type activities. So what say you on this last thing? Have you ever read bad financial advice or a book? What do you want to caution our listeners to pay attention to as we start going through this period of volatility? What are you seeing?
Yeah, so I've unfortunately read that book too, and
it's a great book, but terrible advice.
Yeah, the advice is tough on it. I think a lot of people lose out or miss out on a lot of money by being overly conservative or too negative. One of the quotes that Dave Wagner from our team, I think he came up with this, but I'm not totally sure, but it's pessimism about the long term does not align in any way with the historic worldview. Investors can choose to believe that right now is the beginning of the end, but that is a bet against all of human history and against human nature itself. As has always been the case, progress occurs against an inevitable backdrop of catastrophe. Always has, always will. Invariably, you can always find what you go looking for, and your investment results will probably mimic that worldview. And I think that that's such a great backdrop because, whatever news outlet that you watch will tell you, oh, Trump's tariffs are the best thing ever, or Trump's tariffs are going to send us into the Great Depression.
You're right, yes. And the reality of it is it's probably going to be somewhere in the middle. It tends to work out. Like my grandpa would say, if you roll around in the slop with the pigs, the pigs get happy and you get covered in pig stuff.
Yeah.
Right. So just be careful who you all are following and paying attention to right now. If you got something that you're a little questionable about, reach out to us. We'll give you between me and the support group we have at Aptus, we will give you fair and unbiased our recommendations or our look at it. 251-327-2124. All right, very good. So I'm going to wrap this up real quick. We got one quick segment coming up. We got to be quick with it. So I hope you all learned something from our discussion about our recent financial headlines. For those of you all that want to continue the conversation, again, 251-327-2124, or go to our website, gulfcoastfa.com, upper right-hand corner, click that blue button, put a 15-minute conversation on my calendar. All right, John Luke, coming up next, Josh's crystal ball and big mouth. So what have been some of my predictions? Was I right? Was I ever wrong? What I think is going to affect investors in the near future or maybe the long-term future? We can talk about that and poke a little bit of fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Null, here alongside guest co-host John Luke Tyner. Thank you for joining us, John Luke, man. So, listeners, I'm opinionated. I have strong opinions at times. I would say a radio show host that wouldn't be very interesting to listen to. And John Luke and I are both paid in our respective professions to offer professional guidance and opinions to our clients. Otherwise, just replace us with AI. So, John Luke, I like making predictions, and I'm fairly skeptical of, I'm from the show me state. I'm fairly skeptical of our own industry. There are times I swing and miss. So let's get at it. Let's see what we got here. So I'm going to set the table for you. Exactly 2 months ago, Michelle and I hosted a Coasting Retirement episode called Slaying the Stock Market Boogeyman. Okay. All right. And listeners, if you want to hear that, just go to the podcast tab on our website. In that episode, this will make you chuckle. The Dow Jones the Dow Jones Industrial Average was at 45,000. The S&P was about 6,000, and the Nasdaq was pushing 20,000. Well, with this week's sell-off, we're down 4,000 on the Dow, 3,000 on the Nasdaq, and the S&P's down over 500 points since that time period. So in other words, all the indexes are well within what is considered correction territory. Is that accurate?
Yes.
They're getting close, yes. Right. Our discussion during that episode centered around how the various stock market indexes had consistently gone up and to the right during the past 50 years. I use my lifetime. And it's kind of funny. I don't know if you've ever looked at what the NASDAQ composite index was in 1980. Do you know what it was?
No.
So what is it right now? Just refresh. It's around 17,000.
Yeah.
It was 134 points. Yeah. Is that hilarious? Right. So you get the point. So investors don't give up, don't give in to fear selling, something we talked about in the last segment. So, John Luke, my prediction on the S&P 500 for this year was going to be it was going to close at 6,500. It's bouncing around right now around 5,500. JD Gardner, the guy you work with, was even more optimistic. He hit 6,800. What's your prediction so that when we have you back towards the end of the year, we can pat ourselves on the back or we can make fun of ourselves? What's your prediction for the S&P 500?
Yeah, so we started the year 5,900.
Right.
We rallied about 4% kind of until Trump's inauguration and a little bit through it. We're down about 8% total on the year. So like you said, a little bit below 5,500. I think it's closer to 5,400 after today.
Right.
And then we're down about a little over 12% from the peak of that Trump bump. So that, if you sit and say, hey, we're going to go up 20% from here, that puts you right around your number at 6,500.
Okay.
Man, I think it's going to be tough to dissect a lot of this news in the short run, and I think it's going to have to really dictate of how long until we get that candy, number one. But then number two, all of the all companies and management teams and CEOs have been essentially given a free pass to pass on guidance in their upcoming earnings reports. So that potentially prolongs some of the uncertainty. So long story short, I think we'll maybe eke out a slightly positive year, like 6,100.
Okay, all right. So we're doing this Price is Right style. I forgot to tell you that. So whoever doesn't go, so you may win just by default because you're the low guy so far. 6,100. You heard it here first. Last piece, within a couple sentences, for folks that are scared right now of what's going on in the stock market, what say you as we close the show? Any piece of advice with all the numbers you see every day? What say you?
Yeah, I think going back to that quote from Dave on not betting against the U.S. consumer, the U.S. consumer has a propensity to spend, and you've seen that time and time again. So I think it's probably never really as bad as you think, would be a big takeaway. The U.S. corporate sector is very resilient, and there's so many things that they can do to impact their earnings, not just grow sales, but improve margins, make acquisitions, buy back shares, pay dividends. So I'm bullish long term on the U.S. economy, without a doubt.
Very good. All right, listeners. Well, I hope you enjoyed a little peek into how we form our opinions and make our predictions. We invite you one last time, if you'd like to have a no pressure, no obligation conversation about your investing goals and retirement dreams, give us a call, 251-327-2124, or go to the website, gulfcoastfa.com. Plus, remember, you can always schedule just an old-fashioned in-person meeting at any of our 3 offices, downtown Fairhope, Orange Beach, or Mobile. Folks, that's a wrap for this week. I want to give a huge, huge thank you to my co-host, John Luke Tyner, coming in last second. Aptus Capital Advisors, thank you, buddy.
Yeah, thanks, Josh.
You came to save the day. Thank you to our show sponsor, that's Providence Partners and Jay Stubbs. Thank you to our 2 awesome radio stations, that's FM Talk 106.5 out of Mobile and WHEP 92.5 FM and 1310 AM out of Foley. Many thanks to our provider of our show music, that's a local band, Sloth Racer. Huge thank you to our show producer, that's my son Peyton Null, freshman year, Auburn University, War Eagle. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again next week, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and/or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and/or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Null and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.